All right, man. So, for y'all, those of you that don't know, I'm Derek Seaman, real estate broker here at the real estate team with Fathom Realty. And I'll let Greg introduce himself real quick, and we'll get rolling on what we do and what we can offer.
Yeah, absolutely. So I appreciate it, Derek. I am actually a loan originator here at Lima One Capital. And here at Lima One Capital, we provide business purpose loans. So specifically on the residential side of the real estate investment market. But I mean, really, we got so many different loan programs that are beneficial to whatever type of investors that's out there. So really excited and happy to be on this call to walk through kind of what that would look like and to be able to see how we can help.
Yeah, absolutely. And so obviously, I'm in the real estate business, so I connect with a lot of different loan programs. And what you guys do really stood out to me because it's unique from the traditional brick and mortar style commercial loans versus this type of loans. So I feel like it offers opportunities for some people that just don't know where to get started or what options are out there. Two programs that I know you guys have that really stand out is the portfolio loans with rental properties, where you kind of bulk multiple locations and housing together. The rent, the fix and flips and rent to flip kind of loans that are kind of can be molded around any scenario almost. I mean, you can do interest only to keep the payments low. You guys can
Yep.
do. So let's just dive right into that, man, because I know we're kind of getting a lot of information in a little bit of time. So tell us about a little bit about those fix and flips and those kind of short term rental loans.
Yeah, for sure. So starting off on the short-term side, exactly like you just mentioned, the fixed to rent. So one program that we have that is extremely competitive in the market right now is our fixed to rent program. It's exactly what it sounds like. You start off with a short-term fix and flip loan where we're able to provide the financing for the acquisition or the purchase of that particular property. And then we also provide the rehab funds as well within that financing. So on the back end, everyone's talking about the Burr method, fixed to rent, finding distressed properties, renovating them, putting the rehab in, creating that forced equity that they have in the property instead of having to sit around and wait depending upon what the market's doing. It's cyclical. Everybody knows that. So there's going to be highs, lows, whatever it may be. So really just taking that aspect of the risk out of investing in real estate to where it's like, okay, how long down the road, 1 year, 5 years, 10 years, whatever it may be, being that real estate investing is a long-term investment, just having to wait for those particular properties to appreciate. Instead of that, I'm going to find a property, a distressed property that might need a little bit of work, whether it's heavy rehab to where you got to gut the whole thing, take it down to the studs, or if it's just cosmetic, whatever it may be. Brand new investors, extremely experienced investors that are doing multiple to dozens of flips per month. Regardless, we can work with them. So what that would look like is exactly that. So we can provide up to 90% total loan to cost. So
Which is huge.
meaning
That right there is huge in itself.
right,
I
right.
mean,
In this market, for sure.
yeah.
For sure. So leveraging the money or the assets that you currently have or the investors have to be able to take on more deals. So they're not just having to put all of their time and attention and money that they've saved up over the years to be able to get into real estate investees or real estate investing. They can put that to work across multiple properties or multiple assets. So creating that forced equity, leveraging 90% of the cash that you have to be able to put into that particular deal. The way the way lenders have it set up is there's a particular cap. So yes, you hear 90% loan to cost. As a brand new investor, all that means is what's your purchase price? How much rehab are you putting into it? Take that total cost. We can provide 90% of that from a financing standpoint. So on the back end, say for easy numbers, you purchase a property for 80,000, you're planning on putting $20,000 worth of work into it. Total cost is 100,000. We'll finance 90,000 of that plus closing costs. And then the way you look at the subject to value or the after repair value, so upon completion of that renovation, we can go up to 75%. So essentially that's both protecting the lender, but that's also protecting the investor's profit margins on the
Yeah,
back end. So
absolutely.
they can make the decision, do I want to sell the property? Do I want to hold it as a rental? It's actually not going to cash flow as well as I was expecting. Let's just sell
Right.
it. You're protected.
Yeah, you got
Um,
an out, and you got avenues that you can take there. I mean, and,
exactly.
and that gives an investor because everybody got their own end game. You know, you might buy it, fix and flip it, and like,
Right.
okay, it's not it, like you said. But what's huge about that is even if you have the money sitting there, how many of these loans can you have at a time with you guys? Is it one?
So so if you that's the unique thing,
Yeah.
is if you're a new investor, you can be working on 2 projects at any given time. Once you get to the point to where you've completed 5, we take the training wheels, as you wanna call it, whatever that may be. We take those off and basically just say, "All right, take on as many deals as you're able to with the amount of cash that you have."
And
So
huge possibilities and just to make money. I mean, and it's so easy to
exactly.
it's easy once you definitely for those investors that know what they're doing.
Right.
Now you can do what you're already doing with somebody else's money so you can stretch it out. And that was my point to that question to show people is you got the liquidity there to do one deal at a time using your own money. Now you can do 5 at one time with the same amount of
Exactly.
money, just tenfold what you got coming in.
Right,
Um,
and to go back to what you were saying, so this is what we have a lot of different investors coming to us specifically for our fixed to rent. It's because a lot of lenders that you go to, even if you start off with a fix and flip rehab loan, you still have to wait the seasoning period. Standard seasoning
yep,
period is 6 months within the industry right now. We
yeah,
waive the seasoning period. We
yeah,
also provide a discount for the refinance origination fee, basically telling the investors, "Hey, we'll scale as fast as you're able to scale. So we'll be right there with you throughout the entire process." I know it sounds extremely aggressive, but so for some cosmetic projects, you finish that work in 2 weeks, come back, we're going specifically off of the ARV for the refinance.
yeah.
You can't get that anywhere else.
Absolutely not. I mean, absolutely not. I mean, and I think there's gonna be a lot of people that's listening to this and watches this and like, wow, I didn't even know this was possible.
Right.
So let's talk a little bit on the flip side. What are the qualifying factors? I know that's a lot of people's going to be okay. How do I do this? What do I need to qualify? So tell us a little bit about that.
Yeah, for sure. So on the short-term loan at the very beginning, fix and flip, again, we don't take into or we'll take into consideration experience. That determines basically rates, terms, leverage, all the above. As you gain more experience, we'll actually increase the leverage that we'll be able to provide. You'll get better rates, better terms, whatever it may be. So we'll scale with you and provide better rates, terms, leverage, all the above as you continue to get more experience. However, even if you're a brand new investor, that's we don't look into that because like yeah, if people are wanting to get started in the real estate investment industry, you need a lender that's going to be with you from the very beginning. So we can finance brand new investors as well. Really all we're looking for is minimum credit score of 660, minimum loan amount of 75,000. So that's purchase plus the rehab, the amount that we're financing out of that, depending upon the market that you're working in. You're like, okay, well, yeah, 75,000, that's nothing. Now in
Yeah,
others, it's like that's important information to know. And then from the cash side of things, we're just looking to see that you can bring the cash to close. So I mean, what's nice is the investors will be able to see a term sheet. Basically,
yeah,
if they come to us and they say, hey, listen, this is what I'm thinking for the purchase. This is how much I'm thinking for the rehab, ARV, all the above. So doing that initial research on that particular subject property, I can put a term sheet and a quote together to send over for their review without even them submitting an offer. Some lenders are like, okay, well, do you have it under contract yet?
right.
Absolutely not. You can see, especially when you're getting started, does this deal make sense for me? Not only how much am I going to be expected to bring to the closing table,
Absolutely.
and what do the numbers really look like? So that's another beautiful thing is that we can put those figures together so that investors know what they're getting themselves into before even
Yep.
submitting an offer on a property. So
Absolutely, and that's huge, definitely for those first time kind of people using creative financing and stuff like that because they're all like, oh well, what's it going to look like? What's it going to be
right.
like? How's this work? So it allows them to see it through before they get into the situation. And like, okay, I didn't notice
Exactly.
this or didn't expect this. It's all about preparation, especially for those newer ones or new people to this type of financing. So that's that part of that's definitely awesome. Um, but so yeah, with those fix and flip loans, let's just make a scenario. I call you right now. I found the
Okay.
house, got the kind of numbers to you. What timeline do you usually think? You
To
know
be
what
able
I
to
mean?
get numbers back over to you, or are we
Yeah,
taking it to the closing table? I'll
taking it
take
to the
both sides.
yeah. He said so. I call you right now. Hey, I found
Yep.
a house. This is kind of repair value needed. Let's get it rolling. Send a contract over you. How long does it typically take you to close?
So average time, I mean, we're constantly taking a look at the statistics data tracking to see, all right, what is the average closing time depending upon the loan product that we're working on. So fix and flip currently right now is between 3 to 4 weeks.
Okay.
However, what I will say is it's truly as fast as we're able to receive the appraisal back.
Yeah.
So if you're in a market or you find a pretty niche market where there's not as many investors there, um, to where there's less people buying, selling homes, whatever it may be, where appraisals are required, there's some markets where we're getting appraisals back in a week, week and a half. There's other ones, okay, you're pushing that 3-week envelope.
Yeah.
So, I mean, really, we're able to close within a week of receiving the appraisal back. So, I mean, that's the biggest thing that's contingent upon for the closing timeline. However, one thing I do want to mention, which I don't want to say is a misconception, but it's not really known in the industry, are delayed purchases. So delayed purchases, and I know we've talked about it in the past, talking about investors that have a good bit amount of liquidity on hand. They want to take down some of the properties with cash, or say they're dealing with a seller or a listing agent, whatever it may be, that says, hey, listen, I need to close this deal in 10 days. I need to close it in 10 days, or I'm going to have to go with somebody else. Basically saying, hey, I need a cash offer on this property. So what we do in that situation, if we're not able to close that fast, we can already get the process started, get the deal into underwriting so that we're actually working on the file. Appraisal's already ordered. We're going through the standard process. Even if they need to close in 10 days and we're looking at a closing time of 3 weeks, call it, that doesn't line up with math. But delayed purchase, the investor can go and purchase the property cash. They can come back to us and we'll already be working on the file. So say we close, or we're planning on closing a week after that initial closing date, whenever they purchase the property cash, it's the same exact financing that we originally would have offered. So going back to those numbers, purchase price 80,000, just for simple math here. Purchase price 80,000, rehab amount 20,000. We can lend up to 90,000, right? If an investor comes and they purchase that property $80,000 cash, that's $80,000 of equity, owned property, free and clear. What we do is, hey, instead of that 10,000 that you were originally going to have to bring to the close, or the closing table, plus those closing costs, instead, that exact amount, call it plus the closing costs, we'll call it $15,000. That 10% down payment of total cost plus the closing costs, just conservatively, that's $15,000. Instead of you doing that on the front end, you're just going to leave that $15,000 in the deal, and we'll reimburse you for everything else.
Oh wow, that's
Same
huge.
rates, same terms, same leverage, all the above. It's basically just taking the numbers and flip flopping them.
Yeah, I mean, and that's kind of a cool thing. A different perspective you can take with that kind of delayed purchase stuff is this could potentially be something too that they might already have a property. You know what I mean?
Right.
They can buy it and
Exactly.
then get their money out of it to get to the next one. You know what I mean? So that's another kind of
Exactly.
visual for people to really take in is it so they might even have something sitting that they just bought. They can get a hold of you guys to get their money
Right.
out of it, get that project financed, and then be able to kind of look for another one now versus waiting until that deal's done to kind of get into the next one. Um,
Exactly.
so that's a
Exactly.
whole nother thing. And I'm reiterating that because I know about how big of a deal that can be because we've all been as investors um, tied up in a deal and a deal comes along. You know what I mean? And we're just
Right.
all our money's in this basket and we can't get to it fast enough. You know what I mean? So
Exactly.
it allows people, even if they just use this to keep their money freed up for that scenario to come around. This is a huge opportunity for people, and I think they really need to listen and look into deeper. Obviously, we're brushing over this program and some of the stuff you guys offer, but I mean, really digging in deeper on their own. I think they're going to find a lot of programs other than this one too that they'd be able to kind of cash flow and make some stuff make sense.
For
Um,
sure. And
so I
even
think
then, I mean, if any of the investors that you're working with, or even then, if anybody has any questions, shoot me a text, give me a call, give me an email, whatever is easiest. And I'm more than happy to walk through every single process, what it looks like working with us, as well as what it would look like if you were to go to your conventional bank. That's one of the biggest questions that we
yeah,
get
what's
is,
the
okay,
difference?
exactly. What is the difference? Why would, on a rental property specifically, why would I go and pay a point and a half? So for new investors, 1%, 1.5% more on the interest rate if I can just go down to my bank, my local Wells Fargo, and be able to get a lower rate? The main thing is speed, execution, and knowing that we're actually going to show up at the closing table. So not only that, if you have rental properties, I mean, everybody runs into this eventually if they're going through a conventional bank. So going through a conventional bank, you're going to be capped. So what I mean by being capped is they're taking into consideration your debt to income ratio, all their your W-2s, tax returns, all the above. We don't look at any of that. We look at what's your credit score? Do you have the cash to bring to the closing table? And does the property cash flow and make sense from a numbers standpoint? Because all of our loans, they don't get recorded to or reported to the credit bureaus. So yes, we'll do a hard pull on the credit at the beginning, but we're not going to cap you saying, yeah, you can only have, like, we're looking at your debt to income here. You're
Right.
only able to have 10 rentals. Then you see an investor out there that has 1,000. You're like,
And you're like, how they do that?
Exactly. Like, how do they do that? How do they get to that next step? That's
Yeah.
working with a company like us.
I mean, and that's where like investors almost need to open their eyes, is because, especially in the rental, I know we were talking about fix and flips there for a second, but looking into, and we can kind of start transitioning over to that direction here, just because with the rentals, the interest is, don't get me wrong, every dollar you can save. If you can get a conventional line of credit or something like that, that's a lower
Right.
rate, that's always the best scenario. But when you're
For
looking at
sure.
really scaling, like what you're talking about, that little 1 point ain't making a difference when you're talking about 100 units to a
Right.
1,000 units, because you're not going to be able to make this money here. So you're
Exactly.
missing some opportunities. So having these options, obviously, even if it's a plan B here, your conventional
Exactly.
right
Yeah.
bank, keep that line of credit as plan A, but you don't want to miss a big deal because you don't have a plan B. And that's
Right.
exactly what I visualize when you're looking at this is, I mean, they're looking at the numbers. If it makes money, it makes sense. Your credit's there, everything there. You're going to be able to get that deal done, and the consistency is going to be there. You're not going to have to worry about that other stuff. Maybe it's going to be a
Right.
point more, but when you look at that money you're making, you're not going to make it without that option. You know what I mean? And
Exactly.
and that's the magic here. I mean, it's just putting money in places where it wouldn't be possible without these loans.
Exactly.
Um, and so with that being said, man, speak a little bit on those portfolio programs that you guys offer for those loans. We're talking a little bit about those, and you can even tie in and talk about just the rental ones you got for over 4 units, because I know standard mortgages and stuff like that won't let you buy anything over 4 mortgages or four
Yep.
units. I'm sorry. So just speak on that, man. Tell us about that a little bit.
Yeah, for sure. So I'll talk about it from the rental side. So what we call rental 30, that's basically all our 4 loan options that we have that are all 30-year fully amortizing loan options. Now, those are for rental properties specifically. So you can move forward with a single asset deal to where it's just one property and an individual loan. Or as you mentioned, we can do portfolios. So real quick side note, any of the loan programs or loan options that we have here, you can put them into a portfolio, not just the rental one. So
Oh
fix
wow.
and flip, multifamily, whatever it may be, new construction, all the above can be put multiple properties into one portfolio. So just side note there.
Yeah.
But on the rental side, what's nice is, and actually one of the main reasons why people put properties, so anything 2 or more properties is considered a portfolio. So we don't have a cap on the number of properties that you want to put into the same portfolio. So you can look at it from the side of, okay, there's a little bit of an appraisal risk on this one, and there's 2 properties in the portfolio. This one came back $40,000 less than expected. The other one came back 40,000 more than expected. So if you're taking a look at those as individual deals, you're going to have a variance there to where you're having obviously a lot less cash out on the one that came back lower. But what we're going to do is we're going to take a look at the portfolio as a whole. So
Yeah.
what's the total value? What's the total amount of rent? And we'll underwrite it that way.
Yeah.
So that there's kind of that, it offsets that variance, which it's an incremental difference to how much risk is less, but still, like you mentioned, over time, those incremental differences make a big difference. So,
Yeah. Absolutely. And so with those portfolios,
yeah,
what are the limitations on how many properties and units can be on there? And then obviously cost wise, what's the lowest cost, highest price
yeah,
on
yeah,
this?
yeah, yeah.
You know?
So, yeah, absolutely. So, what we're going to need to see is if it's a single asset, minimum property value that we can move forward with is 100,000, with a minimum loan amount going back to that 75K.
Okay.
Now, if it's a portfolio, each individual property, the minimum property value is 75,000. So if you have an $80,000 property and you're like, man, this one doesn't qualify to be able to put a loan on it, then okay, if you find another property or you already have another property that you
Add a
want to
high
tap into
valued
some
asset in
equity
there.
in, Exactly. So then you can put it in because that decreases the minimum property value requirement from 100 to 75.
Right.
Now, whenever it comes to the unit count, we can do 1 to 4 units. Now, within a 1 to 4 unit property portfolio, we don't have a cap as to number of properties that we can include in one portfolio. So you'll have one mortgage
Wow.
payment. You'll have, and like that's all you have to think about. We escrow for taxes and insurance. So you don't have to worry about your tax payment at the end of the
That's
year. You don't have
yeah,
to worry about your insurance. We handle all of that. And you just pay that monthly mortgage payment for every single property that's in that portfolio. So it's a ease of mind as well. To where you're not having
absolutely.
to fumble. It's like, did I miss one mortgage payment? So
Did I pay my
it's
taxes? I mean,
exactly,
it,
exactly.
it makes
So
it
it's
definitely
all
builds that
handled.
convenience in there. Yeah.
Yep.
Um, that's huge, man. And so, with that being said, on those big portfolios, I think one thing, and this just shooting kind of towards my audience a little bit with the clients
Yeah.
is everybody knows that investor that's slowly thinking about selling their properties. This is an opportunity for those people thinking about selling a bundle. Maybe they own 50 units. You know what I mean? They want to get rid of them. This gives you a way to do that and give the buyer an option on financing. I mean, obviously the
Exactly.
buyer has to qualify, but it's very hard to find this type of financing for people. So this gives them a good avenue and a good connection to make it happen. And me as an agent, it gives me the resources to provide to people. So we can kind of list properties and sell them in different ways and now have the resources to get on that financing that need fast, easy, and conveniently. I mean, you can't
Right.
beat that.
Exactly.
And that leads me kind of to my next kind of question with that. With these bundles, obviously there's a lot more moving parts. You're going from selling one deal to selling potentially 30 properties in one bundle.
Yep.
How does that affect that timeline on some closing?
Great question. Great
Yeah,
question. So the timeline as a whole, I mean, again, comes back to the appraisals and getting those in. But
exactly.
if you're working a single asset deal, so one single property, again, in a one loan amount, if you have 30 properties, instead of it being standard 30 days or less to be able to close, finalize figures with taxes, insurance, get a lease agreement in place, whatever it may be, that's standard for one single property in a deal is 30 days or less. Now, if you have 30 or 15 or 10, whatever it may be, then that's getting pushed out to probably 45, 60 days from a closing timeline, only because, okay, not only are you collecting 30 appraisals at this point in time, you're also
Yep.
taking a look at how all of those different properties and the figures and the rent and how all of those individual debt coverages are impacting each other. So it takes more time to finalize with title insurance, all the above, to be able to
Exactly.
get to the closing table once we do receive the appraisals back. So it
Yeah.
extends it out 45 to 60 days, depending upon the number of properties that are
Yeah.
added.
And still, and that's why I pointed at that is because that's an obvious question. You know what I mean? People's gonna be like,
Right.
okay, 30 days on
Right.
closing. People can't go into this thinking, oh, it's gonna be the same amount of time. It's gonna be a little bit different, but that's still very, very. I mean, you're looking at adding 60 days, even that's 90 days. You're selling 30 proproperties. You know what I
Right.
mean? That's
Exactly.
that's that's not
Exactly.
bad. I mean, that's a great timeline to get some stuff done, and it just takes more time. When it comes to those, and I know you said you had something at 1 o'clock, right?
So that actually just got rescheduled about
Okay.
30 minutes ago. So
Oh,
we're good to
cool, man.
keep
Cool.
rolling.
We're still shooting just because with the Zoom stuff, man, they're just cut you off, not giving you no warning and stuff.
Yeah.
So we're
Yeah. Yeah.
shooting just so we're on the same page for like I can't remember the exact time. I think we started. Let's just say 110,
That's
like
cool.
105, 107. We're start closing out.
Sounds
Um,
good.
on those portfolios, um, that's one payment. I'm just reiterating that puts all that into one payment, the one little segment, so people you don't have to pay 30 notes on these things. So that just builds that convenience there, man, and you can't beat it.
Right. So another thing that I do want to mention,
Yeah,
not only just from the one payment aspect that you're having each month, a lot of the first questions that we get when we're talking about rental portfolios is, okay, well, why would I do that? The reason you want to do that is because you're saving a lot on fees. So instead, if you have one property in just an individual single asset deal, you have one property. We got a flat processing fee, and we have a origination fee as well. As that loan amount increases, so to be exact, as the loan amount increases 500,000, you're getting a discount on the origination fee, and then each individual property that you add after, instead of having that flat processing fee, of $900. Instead of having that flat processing fee, it's actually added on a per property basis after that of, okay, next property 150, property after that 150. So you're saving a lot on lender fees,
Oh
especially
yeah.
as you continue to get, if we're talking 30 properties, I mean, obviously depending upon the asset class that those particular properties are, but I mean, if you're looking at 30 properties and you have two and a half, $3 million loan amount, you're saving a lot on the lender fees side of things. So that's another way to be able to take a look at, okay, how is my liquidity or the cash that I'm putting into these particular deals, or even then the equity on these particular deals, specifically cash out refinance. If you wanted to tap into the equity and move on to the next opportunity, that saves you on just keeping as much cash for the next deal as possible. So that's
Yeah.
another thing that I wanted to comment on, because that's usually the first thing out of people's mouth is whenever you put you quote them all individual, and then they're over there adding up all the numbers. Okay, what's this going to cost? Which,
Yep.
I mean, I invest in real estate on the side as well. I do the same thing. Everybody does it. It's a
Yeah.
numbers game.
It is.
And then whenever you send the portfolio quote back over to them as well, just packaging everything together, like, holy cow, I did not realize the difference that that would make. And I'm like, that's why you go to a private money lender like Lima One Capital.
Yeah. No, for sure, man. And that's what, like, obviously everybody has their own style when it comes to especially rental properties. Everybody
Mhm.
has their own style, their own number ratio, their own style of properties they want.
Exactly.
So there's no one size shoe fits all. So there's gonna be some people that watches this or looks into programs and be like, oh, that don't even make sense. That's everybody has their own way of doing things. Some people only buy rentals with cash. Some people, you know what I mean?
Right.
So it's
Exactly.
not gonna make
Exactly.
sense. But for the most part, I mean, when it comes to buying properties, definitely in bulk, there's not many options out there like this. And so hopefully this video is able to help some people out. So yeah, I know we talked obviously about the portfolio stuff. What if somebody just came at you guys with a 4 unit, or how on that single property multi-unit, how high can you go on unit
So,
count?
all right. So if we're talking unit count, we actually have three different options whenever we're
Okay.
talking about number of units on a particular property. So if we have a 1 to 4 unit property that's brought to us, whether it's short-term fix and flip or a 30-year amortizing rental loan, then that's just everything that we just discussed. Now, we also have the next asset class from a total number of units that goes not from 1 to 4, but 5 to 9. So that's actually a product that we rolled out both on the short-term fix and flip side as well as on the long-term, same four options, 30-year fully amortizing loans. That's what a lot of investors are tapping into right now, is that particular loan product, the 5 to 9 unit, is because, okay, with higher interest rates, a lot of times you're not necessarily going to be cash flowing as well as you were historically on a single, so say a single family residence. So you're not going to be cash flowing as well. The higher unit counts, that's whenever the cash flow that you have really starts to compound. Now, on the multifamily side, we also saw with the property values being higher, sellers actually listing those and trying to sell them at a higher price point than they were actually worth. So that was compressing cap rates. We can get into all that on a
Yeah.
different call if you want to, but
For sure. Or they can. This is where at the end we're going to plug your information so then they can contact
perfect.
you directly
Exactly.
and get
Exactly.
all the little details and all that
Right.
that in the mud stuff.
So on that 5 to 9 unit, that was a lot of investors' sweet spot over the last year in 2022. Whenever you saw the extremely volatile market
Yeah.
conditions that we were dealing with interest rates, is because those properties were the ones that made the most sense. Now, five
Okay.
to nine, technically speaking, is a commercial style property. So the appraisal that we would order on that is completely different from an appraisal that we would order on a 1 to 5 or 1 to 4 unit. So single family is technically considered 1 to 4 units. Um, and then 5 to 9 is technically a commercial property. So don't be surprised whenever the appraisal is a higher fee and it's more upfront just on that appraisal. Specifically talking single family, you're looking between 750 and 950, 1 to 4 units, and then 5 to 9 units. Even though those properties are penciling a lot better, don't be surprised if that appraisal fee comes back $3,000, $4,000 just because of the property type that it is. So I
Yes.
want to put that out there as well over
Absolutely.
on this
For
call.
sure. Full clarity. You don't want no surprises. That's for sure.
Exactly.
Um, And so just a little curveball a little bit. With this, you guys, and correct me if I'm wrong, this is for residential. Do you guys loan on mixed use? If so, what ratio do you want to see residential over commercial?
Right. Yeah. So we can do mixed use.
Okay.
Now, our mixed use would just needs to be leaning at least 70% towards the residential side from an overall square footage standpoint. Now, mainly, I mean, a lot of people might be questioning, okay, what does that look like? Retail space on the bottom, office space on the bottom, apartment complex on the top.
Above.
So
Absolutely.
exactly that.
And that's why I know we spoken, so I kind of got some
Yeah,
trigger points
exactly.
here, and I knew that was a big one. And when you think about that mixed use, that's almost the standard style in a lot of cities, where you
Right.
do have that lower level storefront, then above it you do have that kind of mixed use, and it's easy to get. Definitely, you got a 4-story building, you got the lower half. Typically, you got a 70% ratio there on square footage.
Right.
I mean, or more
Exactly.
to residential. Um, Cool, man. I know I see we got a clock up clicking, man. So I'll tell you what, we just go ahead and kind of close out.
For sure.
If you want to just kind of shout off some ways that people can contact you directly if they have more questions, because I know we put a lot in a little bit of time. So there's going to be questions, or somebody might like, I need to get more information to get connected to get pre-approved and see what that process is like.
Yeah, for sure. So immediately after this, I mean, I know I mentioned it during the call or during the conversation, but shoot me a text, give me a call, send me an email. I'm going to give Derek, to everybody that's listening, I'm going to give Derek all of my contact information, so that you guys have that and can reach out at any time. Again, more than happy to help in any way. I remember what it was like when I was becoming a new investor. So I love having those conversations, talking about the industry as a whole. If there's anything I
Yeah.
can ever do, let me know.
Awesome, man. Well, we'll go ahead and close this up, man. We might have to do a little spin off of this one if people have more questions, and
For
you start
sure.
getting questions. We'll just kind of take that and turn it, building into something else. But my main goal here is just really providing people the resources they need to take what they're already doing, or what they're trying to do, or what they're wanting to do to another level, and give them the tools they need to do it. But
Absolutely. I love
man,
it.
I'll tell you what, Greg, man, it was good jumping on here talking with you, man. I have a feeling we're going to do this again. Just reach out if you need anything, but shoot me over that stuff. I'm going to attach your information for people too. So hopefully we can shake up some business and help some people out.
That sounds good, Derek. That sounds good.
Awesome,
Looking
man.
forward to the next time. Always a pleasure.
Let's do it later on.
All right. See you.